The housing market is facing a storm of challenges and opportunities. Prices are increasing, fewer homes are for sale, and interest rates are rising. But experts say there won't be a crash anytime soon. What's happening? Are we in for a big boom, or is there trouble ahead? Stay with us to find out everything you need to know. First, let's talk about what's driving demand in the housing market. More people means more homes are needed. Many millennials, aged 26 to 41, want to buy their first homes now. The average home price is about $440,000. Even though mortgage rates are around 6.9%, people still want to buy homes. Why are prices so high and supply so low? The problem is, there aren't enough homes available. We only have about 2.5 months worth of homes for sale, but a balanced market needs 4 to 6 months. This shortage keeps prices high and makes it challenging for buyers to find homes. You'll often face bidding wars and must pay more than the asking price. So, why is the market stable despite these problems? One reason is the strong job market. Unemployment is below 4%, so most people can afford their mortgages. Foreclosure rates are also low. Over the past 16 months, mortgage delinquencies have been between 3% and 3%, and foreclosures are around 0.37%. This means homeowners are financially stable, which helps prevent a market crash. But the future is always uncertain. A deep recession or major geopolitical events could impact the housing market, and rising interest rates also play a role. If the Federal Reserve keeps raising rates to combat inflation, mortgage rates could increase, making homes less affordable. Let's dive deeper into pent-up demand. We're currently short by 1.5 million to 7 million housing units. Household growth drives housing demand. And with many millennials eager to buy homes, the demand is skyrocketing. This age group is a powerful force in the market right now. What is the lock-in effect, and how does it affect the market? Another interesting twist is the lock-in effect. Over the past decade, many homeowners have locked in mortgage rates below 5%. They don't want to sell because they would have to take on a new mortgage at a much higher rate. This lock-in effect reduces the number of homes for sale, creating a seller's market and increasing prices. Rising homeownership costs are another issue. Homeownership costs have been climbing steadily. A study by Bankrate showed that maintenance costs for a typical single-family home rose by nearly 26% between March 2020 and March 2024. In March 2024, the median home price was around $435,970. The cost to finance a median-priced home has more than doubled over the past 4 years to $2,278 per month. Adding maintenance cost equals $3,800 monthly, a 64% increase over 4 years. But there is some hope as new construction is rising. Permits for single-family homes totaled nearly 93,600 in April 2024, up 22.5% from the previous year. This suggests home builders are trying to meet the high demand. In some rental markets with high vacancy rates, renters might have some leverage. These markets could offer concessions or even free rent to attract tenants. What do the Housing Market Index, HMI, numbers tell us? Let's look at some numbers to get a clearer picture. The U.S. News Housing Market Index, HMI, is a great resource. In April 2024, the national HMI dipped slightly to 63.8 from 64.1 in March, but still shows a 5.5-point increase year over year. This growth is driven by the demand HMI, which rose 15.6 points to 62 points over the previous year. This increase in demand is due to a strong job market and household growth. The University of Michigan's Index of Consumer Sentiment rebounded to 77.2 by April 2024. The supply and financial HMI present a complex picture. Rental vacancy rates have inched up slightly, favoring renters in some markets. However, construction costs have risen 4% year over year, and builder confidence has dipped from a peak of 51 in April. Despite this dip, it remains higher than in 2024, when it was 43. The financial HMI offers a mixed view as well. Mortgage rates are high compared to historic lows, but income growth and flatter rent growth ease the burden for renters. The ratio of median rents to per capita income reached 3.6% year over year in April. On the other hand, the payment ratio of buying a home with 20% down over a 30-year term to per capita income has rebounded to just over 39%. This ratio is significantly higher than the 19.7% level noted in March 2021, when rates were around 3%. So, what does the future hold? Experts predict that high demand will likely continue due to population growth and millennials entering the market. However, the supply side must catch up to create a more balanced market. This might involve significant efforts to increase new home construction, potentially exceeding the 93,600 permits issued in April 2024. Additionally, exploring innovative solutions like high-density housing and urban redevelopment projects could help meet the growing demand for homes. What does it mean for buyers and sellers? If you're buying, it's a tough market. High prices and low inventory mean fierce competition. Be prepared to participate in bidding wars and pay above the asking price. Get your financing pre-approved and be ready to act fast when you find the perfect home. For sellers, high demand and low supply mean you can sell quickly and for a reasonable price. However, if you plan to buy another house, you'll face the same challenges as other buyers, including high prices and limited inventory. Careful planning and considering all your options are crucial. By understanding the trends and challenges in the housing market, such as rising ownership costs of $3,800 per month, you can confidently make smarter decisions and navigate this dynamic market. Thanks for watching the video. Subscribe to our channel for more updates on the housing market, personal finance tips, and other valuable content.